Welcome, and thank you for tuning in to ESG Talks, a KBRA podcast series focusing on environmental, social, and governance ESG. This podcast series highlights various ESG hot topics and includes commentary from prominent voices within the ESG community. In this episode of ESG Talks, I, Emilie Nadler from KBRA's ESG team, interview Mike Brotschol, a managing director at KBRA Analytics and co-head of KBRA Credit Profile, KCP, a subscription-based CMBS surveillance platform. Mike's team recently enhanced the KCP product offering with various environmental and social metrics on commercial real estate properties. Hi, Mike. Thank you for joining me today. Before we jump into the conversation on KCP, I think it would be helpful just to have a brief overview of how structured finance investors think about ESG. So to start, really, how are investors in the structured space using ESG-related information to make their investment decisions?
Yeah, thanks, Emily. It's great to join you today. I think investors are integrating ESG issues into their investment decisions in many different ways. But before diving into some of those examples, I think it's worth highlighting the level of adoption we've seen in the market. A 2021 report published by the Principles for Responsible Investment found that over 90% of firms incorporate ESG factors into their assessment of securitized products, and that 40% have dedicated ESG teams. So it's clear that ESG has very much penetrated the structured finance market. And if we look at that investor group, that 90% that is utilizing the information, we can break them down into three separate groups, which was also noted in the PRI report. 32% currently have defined ESG frameworks. 23% have internal scoring systems that they utilize to both analyze securitized products and to ensure compliance with internal guidelines. And the remaining 45% are still in the early stages of systematic incorporation. So at a very fundamental level, investors seem to be focused on capturing data, understanding its relevance, and enhancing investment strategies accordingly. From a capital allocation perspective, investors may specifically target green or sustainable assets. This could take the form of investing into either green or social bonds, including those issued by government-sponsored enterprises, or investing into a single asset, single borrower securitization, wherein the underlying collateral property is either LEED or Energy Star certified. Oppositely, but still within the realm of capital allocation, investors may look to exclude certain industries, such as coal, oil and gas, or gun manufacturing, from investment portfolios, which is a process known as exclusionary screening. Within commercial real estate credit, some investors will scrutinize property rent rolls and exclude properties that are leased to companies operating within the aforementioned industries, among others. Similarly, investors may exclude properties or limit exposure to properties that are situated in areas at high risk of climate peril. Investors will also conduct a scenario analysis of environmental issues to understand both physical and climate transition risk. For the built environment, the rate and severity of climate change may directly influence building insurance premiums and the capital required to modernize an asset, that it's both protected from future environmental conditions and remains in compliance with energy benchmarking laws. And investors, I think worth noting, will try to distinguish the timing of events as it pertains to climate change and identify what's most relevant over the short to medium term. There are some environmental events, such as sea level rise, that in certain areas are expected to play out over longer periods of time, maybe 50 to 100 years. In these instances, the change in climate is unlikely to have an impact on default or loss rates for, say, a 10-year loan. But to help refine their underwriting, investors are interested in environmental factors such as energy consumption, greenhouse gas emissions, water usage, vulnerability to physical climate risk, environmental contamination, among many other factors. They might also be interested in the level of commitment local, county, or state governmental bodies have towards the environment. The stronger the pressure from these agencies, the more likely it is property owners will implement environmental improvements over time. For social, investors are thinking about demographic trends, particularly in the wake of the COVID-19 pandemic. They're also thinking about stakeholder preferences that may affect supply and demand, affordability for both housing and basic infrastructure, access to essential services, as well as health and safety issues. Under governance, many investors are interested in the transaction structure and both the role and track record of counterparties, among other issues. Within CMBS specifically, there's an interest in understanding loan structural features and debt stacks, the sources and uses of funds, and the behavior and makeup of both loan sponsors and the tenants occupying space at the underlying properties.
Great. Thanks, Mike. I think that's a really cool overview of just the investor interest on the structured finance side. So moving now to KBRA's ESG expansion of KCP, what really drove the decision to add ESG data into the KCP platform?
As with all prior platform enhancements, adding ESG to the platform was 100% client-driven. Investors need ESG data for security selection, underwriting, and compliance. So we wanted to, facilitate that process and help investors achieve those goals. And we're constantly trying to work with and evolve the data offering, both internally and externally. One example of external research was a report we published in early January, which focused on the environmental performance of Chicago CMBS office properties. These properties, according to our study, outperformed the broader Chicago office market across 3 of the 4 analyzed metrics. That report, which is titled How Green is Windy City CMBS Office, is available through the KCP portal or at KBRA.com. And I think it's also important to note that the ability to develop and provide ESG solutions is supported by, both scientific improvements, including advances in climatology, along with the rise in ESG disclosure laws. The SEC, for example, recently released a climate disclosure proposal, which is currently open for comment. If adopted, the rule amendments would require a domestic or foreign registrant to include certain climate-related information in its registration statements and periodic reports. So while this rule does not currently address structured finance, we expect that it will in the future. Additionally, many state and local governments are considering regulations and ordinances that will require property owners to report environmental metrics or beyond that to adhere to certain performance thresholds or be subject to financial penalties. And there are several trade groups currently that are working with these governmental agencies to help them design and implement new policies.
I'm glad you brought up the SEC proposal because it's definitely going to be important to watch how that disclosure proposal evolves, as it's really likely to have an impact across most sectors. So when was the KCP enhancement launched and what metrics are covered?
Yeah, so in September of last year, we launched an ESG supplemental report that includes building level environmental data. So even within a single CMBS property, oftentimes we'll see there could be multiple addresses, multiple buildings, and the data we have is at that most granular building level. We have data for the properties securing the 10 largest loans in the pool. And at the time of our launch, we had ESG reports for the majority of our coverage universe. So that included conduits, single borrower, and large loan securitizations. So we were able to identify 14 markets and jurisdictions nationwide that had available environmental performance data. And we scraped that underlying data and mapped it back to CMBS collateral. This was a very time-consuming and resource-intensive process, but we knew it, would ultimately be worthwhile. Some of the markets that we have information on include Chicago, New York City, Philadelphia, Washington, D.C., and the state of California, to name a few. And what we found with these data sets is that they're unique to each jurisdiction, but there was an overlap of key metrics available, and that became the foundation of our reports. Beyond having this information, for properties underlying these mortgages, we have a history of performance as well. So depending on the jurisdiction, we have upwards of 10 years of history for any single building. So that was our September 2021 launch that included the environmental performance data in those 14 markets. In the fourth quarter, we spent more time on the project and added 6 new markets under coverage, which brings us to 20 total markets. We also added 3 new data points on the environmental side, which includes the source energy use intensity and a greenhouse gas intensity figure. And we also added reports for our Freddie K transactions in our coverage universe. And in doing so, that gave us complete coverage on the site. So any deal that we have a KCP report for, we also will have an ESG supplemental report. And also with our Q4 efforts and our January 2022 announcement and enhancement is that we added social data to the reports. So we added a tab that has census data, demographics data, and that's sourced from the American Community Survey, which is one of many surveys that the U.S. Census Bureau conducts annually. And the great thing about this information is that it's available for all CMBS properties within a transaction, every address. And to look at the contents of the report, starting with environmental, we have an Energy Star score. The Energy Star program is run by the EPA and the Department of Energy, and it provides a means of benchmarking the energy efficiency of commercial buildings and industrial plants, as well as equipment nationwide using a 1 to 100 scale. An Energy Star score of 75 or higher indicates eligibility for Energy Star certification, which is important for structured finance investors to recognize, being that these Energy Star certified buildings use 35% less energy on average and generate 35% fewer emissions than their peers. We also have the site and source energy use intensities. To break that down a little bit, a source energy measures the total amount of raw fuel it takes to operate a building, inclusive of energy consumed on site, which is the site energy, and energy that's lost during generation, transmission, or distribution. Site energy can be delivered in the form of primary or secondary energy. Primary energy relates to the raw fuel used to create heat and electricity, while secondary energy is the energy product created from raw fuel, such as electricity purchased from the grid. So the site EUI, again, energy use intensity, is calculated by aggregating the total sources of energy consumed on site in kilo British thermal units. That's the metric, that's KBTU, and dividing that aggregate number by the building size. So site EUI is ultimately defined in KBTUs per square foot. A source EUI, again, is in KBTUs per square foot. And the way that we arrive at a source EUI is using national conversion rates that, depending on the form of energy being utilized by a given building, it will translate that building site EUI into a source EUI using this ratio. In addition to the per unit measures of energy consumption just described, we provide total site consumption as well as consumption by type in our supplemental report. And each of those figures is, again, in KBTUs. Energy sources include electricity, either purchased from the grid or generated from on-site renewables, natural gas, steam, hot or chilled water, as well as liquid fuels, including fuel oil, kerosene, and propane. Also included in our reports is a water use intensity figure, which looks at the total gallons of water consumed at the property on a per square foot basis. And last but not least is greenhouse gas emissions, which are presented in total emissions in the form of metric tons of CO2 equivalent, as well as from an intensity perspective, where we look at kilograms of CO2 equivalent per square foot. And again, all of these per unit measures are very helpful as they allow users to compare properties of different sizes. Understanding these metrics, which are only a small component of available ESG metrics, but understanding them really does help to improve the visibility of credit risk. From a property cash flow perspective, there's implications for both revenue and expense. On the expense side, there's concerns for higher insurance premiums, higher utility costs, and elevated CapEx. There's also potential fines for non-compliance with energy laws, which can impact the bottom line. On the revenue side, there's evidence that greener buildings do command higher rents and can also attract a wider array of tenants. Looking at the office sector, for example, companies, may generally look to occupy less space post-pandemic, but the space they do occupy, they want it to be within a highly amenitized building that's environmentally friendly, thus adhering to their corporate sustainability initiatives. So Class B and C office properties with outdated systems, high energy requirements, and inefficiencies, we anticipate will struggle the most going forward. From a property valuation perspective, outside of the aforementioned cash flow benefits, greener properties often trade at lower cap rates. So lower cap rates and higher cash flows will have a dual benefit on pricing. So that covers the environmental data that we have within our supplemental report. On the social side, the data we've sourced is, again, from the American Communities Survey put forth by the U.S. Census Bureau. We have 137 fields per CMBS property, per address, really. And that's across 6 different census geographies, which are the census tract, which is a collection of census blocks. And simply put, I guess, roughly half the size of a zip code. The second layer is the zip code tabulation area. Then we have the census place, which could be a city, town, borough, or census designated place, followed by the county, state, and then core-based statistical areas, which are micro or metropolitan areas. So we have 22 overlapping data points that are at each of those 6 geographic levels, and then another 5 data points that are unique to a given geography. And the data that we have really gives investors the ability to ascertain average household income, gross rents, population statistics such as size, age, earnings, and median housing value, all based on a property's location.
That all seems like such valuable information to have at the property level. So can you talk a little bit about the feedback you've gotten on the ESG product offering for KCP so far?
Sure. The feedback has been, overwhelmingly positive across the board. Subscribers have appreciated our data-first approach and seem very excited to see, how the offering will grow. And it's been rewarding for us as well that we've been able to accommodate the specific needs of market participants and to do so in a timely manner. Also common to our discussion with investors is just that many of them are still in the discovery phase. So they're trying to understand what data is available, why it's important, and how they can systematically incorporate it into their investment process.
It definitely does seem like a data-first approach is exactly what the market is looking for in the ESG space. I know on the ESG team, we really hear over and over again from investors the challenges of accessing quality and comparable ESG data. So can I ask, does the KBRA analytics team plan to incorporate additional ESG metrics on the KCP platform?
Yes, we're planning to expand the offering on multiple fronts. On the environmental side, we're tracking more than 15 jurisdictions nationwide that we expect will start reporting environmental performance data either this year or next. Those markets would be in addition to the 20 that are currently under coverage. So hopefully over the next few years, we can come close to doubling the number of markets under coverage. We're also working to identify CMBS properties that have received LEED certification from the U.S. Green Building Council. LEED certification is highly reputable and globally accepted. The program aims to improve a building's performance across a variety of green areas, including energy efficiency, water management, material and resource use, and indoor air quality. On the social side, we'll be significantly expanding the number of demographic fields available from 137 fields per address to nearly 1,300 fields. We're also working to identify properties situated in opportunity zones, which should be available very soon to subscribers of the KCP platform. So these are just a few of the enhancements currently in our pipeline.
Great. Well, thanks so much for joining me today, Mike. I think this has been a really helpful overview of KCP information, the KCP ESG information we currently offer, and a really interesting discussion on investor and structured finance space. So it seems like there's a lot more to come from the KBRA analytics team and KCP in particular with regards to ESG information.
Yeah, thanks, Emilie. I really enjoyed the discussion.
This concludes our episode. Please email esg@kbra.com with any questions or comments. You can find more information on KCP and its ESG services by visiting kcp.kbra.com. We also encourage you to visit KBRA's ESG website at esg.kbra.com, where you can find ESG research related to the topics discussed in this episode, further details on KBRA's ESG approach, and other ESG-related media items. You can also join our mailing list to access our ESG Weekly Roundup newsletter.